Now, let's talk about the downsides, the things you really need to be careful about.
The not so fun part, right?
Yeah, the things that can trip you up. So, the guide is very upfront about this. The cost of MCAs, that's a big one
It is, yeah. You're often paying a lot more than you would with a traditional loan.
because of those factor rates.
Yeah, those factor rates. If you do the math and figure out the equivalent APR, it can be way higher than a loan's interest rate.
And because MCAs are usually unsecured,
Uh-huh.
that makes them riskier for the lender.
Right, they're not protected by collateral, so they charge more to compensate for that risk.
Okay, that makes sense. And this higher cost, it can lead to a scary situation, right?
Yeah, the debt cycle.
That's what the guide calls it.
The debt cycle.
Explain that.
So imagine this. You get an MCA, and the costs are high, and you have to make these frequent payments.
Right, daily or weekly.
Exactly. That can really eat into your cash flow. And then what happens? You need more money just to cover your bills.
So you get another MCA.
Exactly. And then another one and another one. It's like a snowball rolling downhill, getting bigger and bigger.
So you're stuck in this cycle of debt, constantly taking out new MCAs just to pay off old ones.
That's the trap. You end up spending so much of your revenue on repayments that you can't invest in growing your business.
And it affects your credit score too, right?
It can, definitely. Makes it harder to get financing in the future. And for the business owner, it's incredibly stressful.
It must be. So that impact on cash flow, that seems like a huge concern.
It is, yeah. Those daily or weekly repayments, even though they change with your sales, they're always there, taking money out.
So it makes it hard to plan, right?
Totally. It's unpredictable. One day you might have enough to cover your bills. The next day you're scrambling.
And it makes it harder to invest in your business to grow.
It does, yeah. Because you're always worried about making those MCA payments.
Right. It's like a constant drain.
It can be, yeah. And some agreements, they even have rules about minimum balances or minimum sales.
Oh, really?
Yeah, so even more pressure on your cash flow.
And then there's this issue of regulation, or rather the lack of it.
That's a big one.
The guide points out that MCAs aren't regulated as much as traditional loans.
Right. And that can be a problem.
How so?
Well, because there aren't as many rules, different MCA providers can do things differently.
So it's hard to know what you're getting.
Exactly. And there aren't as many protections for businesses, things to prevent predatory lending.
What's predatory lending?
It's when lenders take advantage of borrowers, with unfair terms or hidden fees.
Oh, wow.
Yeah, it can happen. And if there's a dispute, it can be harder to resolve.
Because there's no clear set of rules everyone has to follow.
Exactly. And it makes it difficult to compare different offers because there's no standard way of disclosing all the terms and fees.
So it's kind of a Wild West out there.
A little bit, yeah. Some states are starting to create their own rules, but overall, it's still pretty unregulated.
So let's recap those key disadvantages.
Okay.
High costs, definitely.
Ah,
The potential to get trapped in a cycle of debt, that's scary.
it is.
The unpredictable impact on your cash flow, and the fact that there's not much regulation to protect you.
Those are the big ones to watch out for.
Okay, so considering all this, the good and the bad, how does a business owner decide if an MCA is right for them?
It's a tough decision.
It is. The Ultimate Guide, they have some advice. They say businesses that process a lot of credit card transactions every day, like retail stores or restaurants, they might be good candidates for MCAs.
Yeah, because they have that steady stream of revenue coming in.
Right. And businesses that have seasonal ups and downs in their income, they might like that flexible repayment structure.
It can be a good fit for them, yeah.
And if you need money fast, and maybe your credit isn't great, an MCA could be an option.
Especially if you're a newer business or you're growing quickly and need a short-term cash injection.
So younger businesses, startups, they might find MCAs useful.
They might, yeah. But it's important to remember those costs can be high.
Right, that's always the trade-off.
Exactly.
And the guide mentions some specific industries that use MCAs a lot.
Right.
Retail, they use them to manage inventory. Restaurants to cover expenses and repairs.
Makes sense.
Hotels and hospitality, they use them for renovations. Service businesses for equipment and expansion.
Yeah.
E-commerce for marketing and inventory. Construction to handle those cash flow gaps between projects.
Right.
And even healthcare practices to buy new equipment.
So a wide range of industries.
It is. So when should a business seriously consider an MCA instead of other ways to get money?
The guide lays out a few scenarios.
Okay.
If you have a short-term cash flow problem, like a temporary gap you need to bridge, if a great opportunity comes along and you need money right away to grab it.
Right. You can't miss out.
Exactly. Or if your credit isn't good enough for a bank loan,
Okay.
Or maybe you have lots of credit card sales, but you don't have a lot of assets to use as collateral for a loan.
Right. Those tangible things the banks want to see.
Exactly. And if you've tried all the traditional ways to get financing and nothing's worked, an MCA might be your last resort.
But always, always remember those higher costs.
Always.
So the big things to think about are, do you have a lot of sales? Do you need the money for a short-term thing? Does the benefit outweigh the cost? And have you tried everything else?
Those are the key questions.
Okay, so let's say you've decided to look at some MCA offers.
You're ready to shop around.
How do you compare them? How do you really understand what they're offering?
Well, first off, you got to wrap your head around that factor rate.
That multiplier, right?
Yeah, that's the key to figuring out how much you'll actually have to pay back.
So a higher factor rate means you pay back more.
Way more. The Ultimate Guide recommends trying to convert that factor rate into an APR, an annual percentage rate.
Okay.
That way you can compare it to interest rates on loans, apples to apples.
Makes sense. But the factor rate you get offered, that's going to depend on your business, right?
Absolutely. How risky they think you are, your financial history, all that.
So you might get a better rate if your business is doing well.
You might, yeah.
Okay, so it's not just about that one factor rate number.
No, you got to look at the whole picture to really know what it's going to cost you.
What else should you be looking at?
Well, the guide says to consider the total repayment amount, how much you'll have to pay back in the end.
Okay.
What the APR actually is once you factor in all the fees and stuff.
Right.
How long you have to repay it, the whole time frame.
Okay.
And all those little fees they might tack on, origination fees, monitoring fees, any administrative charges.
You can add up.
It really can. The guide suggests using online calculators or even talking to a financial expert.
Right. To make sure you're getting an accurate picture.
Absolutely. And remember, the actual cost can change depending on how much your business is selling.
Right, because the repayment period can be longer or shorter.
Exactly.
So, are there any red flags, things that should make you wary of an MCA offer?
Definitely. The guide points out a few big ones.
Okay, what are they?
First, if the factor rate seems really high, that's a bad sign.
Okay.
And if they try to pressure you into signing quickly without giving you time to think it over, that's another red flag.
They're trying to rush you.
Exactly. A good provider will give you time to consider your options. And if they're not being transparent about the terms, if things are unclear or hidden, that's not good.
Right, they should be upfront about everything.
Absolutely. And if they don't really look at your business's finances before making you an offer, that's a red flag too.
Like they don't really care about your situation.
Kinda, yeah. And if the offer seems too good to be true, it probably is.
There's always a catch.
There usually is, yeah. And if they want you to pay big fees up front before they even approve you, that's another warning sign.
So be careful. Do your homework.
Absolutely. Don't jump into anything without understanding it fully.
So you're saying it's really important to shop around, compare different offers.
Oh, definitely. The guide recommends creating a system for comparing them. Host Speaker.